Now let's practice the PPE in IFRS, impairment loss in IFRS. As we discussed in class, under the GAAP, impairment loss is starting from the impairment test comparing the book value and the total future undiscounted cash flow. And then once the book value is greater than undiscounted future cash flow, now they have to move it to the impairment loss recognition when the book value is greater than fair value. If the book value is lower than the fair value, it's not necessary to recognize impairment loss. But the IFRS, there's a little bit complicated procedure than a GAAP, but the simple one, except for the calculation, complicated calculation, the test and the loss are the same procedure, which is the book value is greater than the recoverable amount. So recoverability, the measuring the recoverability is the point in IFRS to determine impairment loss. Recoverable amount is the max of the present value in use and net selling price. So this present value in use means now the discounted future cash flow, comparing undiscounted future cash flow under the GAAP. That is the distinction. Also, net selling price, which is net realizable value, which is calculated by the fair value minus the selling cost. So if the present value in use is greater than the net selling price, then the company can choose this present value in use for the recoverable amount. If this recoverable amount is lower than the book value, now directly they recognize the loss. Then recovery is allowed in any cases. In any cases, we distinguish this recoverability for the previously impaired asset under the GAAP. Recovery was not allowed if continued to use. Once the company decided to dispose this asset, then recovery is allowed under the GAAP, only up to the original cost. You may remember one of the midterm topics. So let's go to the exercise here. Information related to equipment owned by K company follows. Original cost 900,000, accumulated depreciation to date 100,000, expected future cash flows, which is undiscounted, 825,000, and fair value 790,000, and present value in use 785,000, selling cost $30,000. So let's do this impairment test and loss recognition under the GAAP. Impairment test, book value is greater than undiscounted cash flow. So again, the impairment test and the impairment loss, the criteria is different under the GAAP. So the first step is to recognize impairment test if the book value is greater than undiscounted cash flow. The book value of the equipment, how to calculate it, right? The original cost is $900,000 minus accumulated depreciation, that is the book value, so $800,000. Undiscounted cash flow, $825,000, which is a given number. So which is greater, right? The undiscounted cash flow is greater. So we don't have to go to the impairment loss recognition. So there's no entry. Also, no entry. Okay, despite the book value $800,000 is greater than fair value $790,000, which is $10,000 impairment. But this case, the impairment test doesn't pass, right? So we do not recognize any the impairment loss. But under the IFRS, we need to use the book value is greater than the recoverable amount, which is the max value in use or a net selling price. Okay, so let's go step by step. the book value of the equipment, again, $900,000 minus $100,000, the depreciation up to the date, so 800 starting point. And then value in use, how much is the value in use? We have a given number, $785,000 present value in use, which is different from undiscounted future cash flow, or 825. Don't put $825,000 in value in use. Okay, that is the present value of expected cash flow. And then net selling price is calculated. Fair value $790,000 minus selling cost $30,000. So we got net realizable value, which is the net selling price, the same concept. And then a recoverable amount, we needed to find which one is greater, right? This value in use $785,000 is greater. So let's compare this book value with this recoverable amount, which is greater, right? The book value is greater. That means that the company should impair by amount the difference between the book value and the recoverable amount chosen, $785,000. So we should go impair, and then impairment loss amount how much is that? The difference between 800 minus 785,000, so $15,000. And then how do you reduce? Do we put this equipment directly? No, we do not change original cost based on the original cost principle. So what account do we need? Right, accumulate depreciation. Accumulate depreciation same amount. By doing so, we can reduce the net book value of this asset. Okay, that is very simple exercise. See you in the next video clip. Bye bye.